Hello, everyone, and welcome to today's call with Eric Nell from Terebinth Capital. We've recently introduced Terebinth into our hedge fund solution. So welcome, Eric. How are you doing?
Well, in you, man.
Excellent. Eric, maybe just to kick off, can you give us a broad history of Terebinth and how long you guys have been managing hedge funds?
Sure. It's actually our 10th year they're in existence. We are celebrating our actual 10-year anniversary in a couple of months' time. And it's amazing how fast this 10 years has gone by. The business was originated in 2013, really with this concept and idea of trying to show South Africa how to build an inclusive society. And an analogy that I often use is a developed farmer selling a farm to a developing farmer. You know, it's all about the legacy that you want to leave behind. So if you stay behind and you teach the person how to use all the tractors and the stuff on the farm, you actually leave behind a very successful farming unit for future generations as well. And I think that the future success of South Africa lies in people that have the skills, staying behind to pass on those skills. And then also alongside that, the importance of, at the onset, we made it very clear that we wanted to be a business that also promotes and advance not just young talent, but specifically also female talent. So we're very happy to say that after 10 years, our business remains a business where in excess of 50% of our business are female. And specifically also across all areas of the business, not just in the operational area, which is something that you often find in these type of businesses. Our entire business, across all divisions, we have at least gender neutrality. And then I think maybe just a final comment on the business. Obviously, it was started as a hedge fund specialist, but from day one, obviously, we also had the Strategic Income Fund, which is, I think, one of our flagship products still today. So that hedge fund mindset has probably persisted throughout the journey over the last 10 years, where we're known to be a manager that has an absolute return mindset. And I think the other thing that then differentiates us also in that regard is our very macro approach. So best investment views, very actively managed.
And just staying with the firm, just can you give us a sense of the size of the investment team and sort of how you've grown in that journey?
Yeah, maybe just to take a step back on that question and just emphasize that because it was our view at the onset that as a smaller boutique type of business competing with the larger managers, and scale is important in this industry, and also the fear that regulatory changes and fee compression will eventually mean that smaller businesses will have to fight smartly and differently, we chose an outsource model at the onset. We still run a hybrid version of that model today. And what an outsource model really means in our world is we outsource what we would refer to as ancillary services, not non-core, but what we would see as core is risk management and money management. So on a day-to-day basis in the office, we employ 13 people on a full-time basis. That's split between Cape Town and our Joburg branch. In the Joburg branch, you have the equity listed property and a part of the business development team. And then in Cape Town, predominantly the fixed income specialist together with a large part of the operational unit. And then we outsource to what we believe to be some of the best service partners around the country across areas such as compliance, management accounting, legal, HR, etc.
I mean, as you said in the beginning, you started as a hedge fund business. Can you maybe just express some of the benefits of that broader mandate, that ability to be both long and short the market over a traditional long-only fixed income type product?
Look, I think if we go back to the traditional concept of a hedge fund, the idea really of a hedge fund originally was to protect the downside. And that long-term wealth creation lies in incrementally in bits and pieces where the opportunities arise, grow performance, but that long-term sustainable incremental and excess alpha is generated by those who protect the downside best. And so for us, it's very important, even if you don't know what these ratios mean, it's well worth going to investigate them, is a successful hedge fund unit over the long term are those units that have better omega and Sortino ratio. So if you're not familiar with those terms, start researching them if you are interested in hedge funds. So I think our hedge fund over the long term, probably the key differentiating factors has been this macro approach. So the returns does not just come from a single or one or two drivers of performance. Sometimes people would be overly focused just in short-term interest rates or just in arbitrage ideas. Our macro approach means that we apply our views across the entire investment and business cycle. And so the attribution analysis over the last 10 years will show that the returns come from various drivers. But it's really, I'd say the secret sauce lies in protecting the downside over the long term.
I'm going to move the conversation a little bit more specifically to the Amplified Diversified Income Retail Hedge Fund. Can you just give the audience a broad understanding of the investment process, the mandate of that specific fund and what you're trying to achieve?
So the fund that you referred to is a segregated mandate and is one of 5 in our hedge fund. All the mandates are managed in exactly the same way as the main fund that was actually launched in 2009 already. So I've been managing on a non-stop basis that fund since 2009. Previously, that mandate was referred to as either the Atlantic Point Macro Hedge Fund or MAP 130. And then more recently, when the MAP platform transferred to a new platform, that name fell away, but we still have that track record. So the mandate is exactly the same. And really the objective of first and foremost of that fund is to outperform cash by 5% over rolling 3-year periods and not have excessive periods of long drawdowns. We also try our very best to not underperform cash ever and definitely not to have a down year. I'd say over the last 13 or 14 years, we've managed to achieve that. So I think it's probably already a recognition that protecting the downside is something that does assist with long-term sustainable growth. And so I think the funds managed to achieve somewhere around the effect of cash plus 7 to 9% over the very long term because of protecting the downside. It does implement strategies across the broader spectrum of the income space, utilizing the entire tool set depending on where we are in the macro cycle. And I think another differentiator then is actually it has mandated stop loss limits. So if the fund is down a certain percentage, we have to cut back a certain amount of the risk. And if it's down more than that, we have to cut back even further. So those mandate limits have really protected investors over the long term. And then the fees are available if you reach out to the Amplify people for more detail.
I've really thoroughly enjoyed getting to know the fund and speaking to you, and your insights on the macro side are amongst the best that I've spoken to. I think just to give the audience an understanding of the thought process, people are very familiar with long positions. Can you give us an idea of where you're a little bit more conservative and you might be more on the short side of things at the moment?
Thanks, I appreciate that comment. I've just returned from the Glacier Summit, and it was interesting how people continue to criticize macro as an investment discipline. It's not very often that you find macro people criticizing other disciplines. I don't know why people feel the need to feel that they have to comment on other people's investment disciplines. I think each to his own. Look, I think you asked a question earlier, and I don't know if I did it justice in my response. Just the tool set obviously allows you to short. So apologies if I did not get to that question the way that I should have. But the key differentiator from a hedge fund to a long only fund obviously is that the tool set is greater, and part of that greater tool set allows you to be net short, which means that if we don't like something, we don't just underweight it, we can actually sell it without owning it. So you can express your purest view in any instrument, asset class, or strategy by actually shorting it. It does depend, and I don't want to become too technical then on what type of investment structure you have, whether it's a RIF or a QIF. With the RIF, the regulations are probably slightly stricter, especially in the fixed income space, where there's still a gross misunderstanding by the regulators and some other parties with regards to what type of leverage should be allowed and what not. And that's a big constraint in the fixed income space, which I truly hope that Treasury and the regulators can wrap their heads around so that we can be allowed to express our views for investors the way we should be allowed and we were in the old days. But the long story short is that I think at the moment, over the last few months, it was very hard to justify being net short or very aggressively short anything, quite simply because oil surprised us to the downside over the last few months, and that was probably the biggest catalyst over the second half of last year for the sell-off that we experienced in the first half of the year not to continue, even though the economic climate and the macro backdrop was quite negative. Second to that, obviously, was then the much faster than earlier anticipated Chinese reopening, and specifically also that 5-year plan and the reappointment of the Chinese premier set the stage then for this perceived next wave of a shift potentially from DM to EM, and all those things are drivers of reasons to be long or net received or positive rather than short. I think after having a very strong performance over the last few weeks, some circumspection is probably more justified after very strong rallies in a lot of things. And especially when you consider there's load shedding, the risk of a grey listing, and Eskom debt transfers and all these things, national budgets, states of the nations. There's quite a few things happening over the next few weeks. And that's not even speaking about the global backdrop. So maybe just banking some profit and things that have run too hard, maybe you start thinking about whether you want to introduce some short side positions as well.
Yeah. And in terms of how active is the strategy, and maybe just referring to turnover ratios, can you give us some insight there?
I'm going to be frank in the sense that we definitely don't do those calculations. I feel that the notion that one should measure how many times you turn over your portfolio stands the risk of it becoming a target. I think about taking risk and taking positions and having a view in 3 very simplistic ways. I'm bullish, I'm long, I'm bearish, I'm short, and if I don't have a view, I don't have a position. So don't trade just for the sake of trading. That's churning, and to my mind, that's a breach of fiduciary duty. So obviously the hedge fund will be turned over quite a few more times than the traditional long-only fund, but it would be nowhere close to some of the higher turnover portfolios in the fixed income space. I think it's in the name of the fund that it's a macro fund, and thus it should probably trade a lot less than some of the other products out there.
And my final question to you, and maybe before I ask it, I mean, we're certainly excited to have you in our solution. I think last year's performance was exceptional, and more important to us, your long-term performance has been excellent. Maybe to everyone on this call, and particularly IFAs, why should they think about hedge funds in their strategies for their clients?
I'm nervous to not repeat what everyone else does, but I think the opportunity set is just broader. So you're doing yourself a disservice by not having that diversification benefit. I think also this very inappropriate discussion around the perception of high fees should stop. I never ever see that question asked to any other part of the financial services value chain. Starting right from IFAs all the way through to high equity funds or balance funds. There's expensive products and areas in the value chain everywhere. The notion that hedge funds are expensive, I really think that conversation should stop. A hedge fund by far requires the most amount of work in the investment space, by far. It is really the equivalent of having a newborn baby. If you turn away from it for a few seconds, something really can go wrong. If you have the wrong amount of leverage and the markets change dramatically relative to your view. The diversification benefit and the broader tool set, those are 2 very, very good reasons to have exposure to it. And I think your long-term investment plan is obviously something that you need to take in consideration. It is a more complex asset class. And so people need to be sophisticated or educated well to understand the complexities of gearing and being allowed to short. So if something goes wrong in a product that you don't understand well, you need to understand the pros and cons of that. It's normally a good idea to understand that if someone can make 5%, they can also lose 5%. That's normally a good base to start from.
Eric, I want to leave it there. I thank you very much for making yourself available for this call, and wishing you all the best for 2023. May you continue to produce excellent results for your investors. Thank you.
Thank you to you and your clients also for the support. We truly appreciate it.
Excellent. Thank you, Eric. Take care.
Thanks, you too.